before school lunch. Now I spit a 16 straight with no punch.
Hey everyone, how's it going? This is Norm Schriever, Real Estate and Mortgage Marketing with Norm podcast. Hope everyone's doing great. Had a really cool guest on today. Casey Fleming, a longtime mortgage broker and lender out there in the Bay Area. But he's done something absolutely remarkable. He's the author of the book, The Loan Guide, How to Get the Best Possible Mortgage. And his website is loanguide.com. But Casey's done something really different and unique that basically shows how all the refinance and mortgage calculators that are standard in the industry these days, especially on the prominent websites, are all actually incorrect. So when consumers go in there and they're putting in the numbers and trying to see their break-even point and when a refinance actually saves them money, the calculations are incorrect. And Casey's going to explain why and give us the tools and resources so lenders or their clients and consumers can really get the accurate math on refinance calculators. So I hope you guys really enjoy this. It's definitely educational. Without further ado, here's Casey Fleming.
Okay, perfect. Well, I'm here today with Casey Fleming, author of The Loan Guide, How to Get the Best Possible Mortgage, a pretty important thing. So, Casey, thank you so much for being on the podcast this morning.
Thank you so much for having me. I'm looking forward to it.
Yeah, and we had a nice conversation already about the great weather on the West Coast, and I feel like I'm crazy now spending my time on the East Coast.
Yes, no, it's amazing out here. It really is. That's why everybody's moved out here.
Yeah, that's maybe too many people, huh?
Well, yes, that's true.
Well, yeah, I'm so glad we could connect. You're doing some really interesting things, and it's really sounds like you put decades into it, not just being the typical mortgage broker, but creating some really unique content that helps consumers and anyone who's looking to calculate the true cost of a mortgage. So if you don't mind, why don't you just introduce yourself quickly and tell us about yourself?
Sure. I'm Casey Fleming, and I've been in the mortgage industry for about 41 years. I started off as an appraiser, sort of evolved into a commercial real estate appraiser, built a small firm around that. But in the 90s, I realized that the appraisal business itself it's very interesting and very challenging, but not a particularly good business. And so I just became more interested in working with consumers and doing mortgages. So I migrated in the early to mid 90s into doing only mortgages. And that's what I've been doing ever since.
Okay, got you. So the commercial mortgage appraising business is it's wild, huh? It's not so easy.
It's just hard to maintain any sort of consistent flow. And when it's busy, the profit margins weren't high enough to be able to pay for the slow periods. So owning a small shop turned out to be kind of a bit of a challenge because the bottom line is there was times when I didn't have any business to feed people, and it just got tiring after a while. I ran it for about 15 years, and we were actually quite successful for that business.
Yeah,
and I realized that I wanted to do something.
Feast or famine, the nature of that business, huh? Yeah,
it was, and I just wanted to do something with consumers.
So when you moved over to the consumer side, it must have been like 100 levels of technicality and complexity were removed. Did you find it a lot more simple and even gratifying going to the consumer side?
Yes, and I don't want to denigrate my industry, but
of course.
Commercial appraisal and investment analysis is far more complex than what we have to do with mortgages. So what I found was that other than just learning how to work with clients and with lenders, and learning how that piece of the industry worked was really the only challenge, and that was pretty easy to overcome.
Yeah,
the technical aspects are pretty easy, at least the way that they're normally practiced.
The hard part about the consumer side of mortgage is people, right? And we'll never figure them out. You could give them all the best information, the best deal, the best rate, everything is logical, and they still make some harebrained decisions sometimes.
Some do, but they usually have a reason, and that's what's been really interesting is I come from the point of view that whatever's going to be save them the most money over time would always be the one they would choose, and that isn't true.
No.
Sometimes there's other motivations, and so what I've learned is I love working with clients. The clients are terrific. The lenders can be a real pain in the neck, but the clients, as a whole, are very, very nice people.
Mm-hmm. Yeah, good answer. Good diplomatic answer there. But and also when you got started in consumer or residential mortgage lending, you created a very, very interesting and unique niche pretty early on, huh?
I did, and that's I'm in Silicon Valley. I'm right in the heart of it, and so organically, most of my clients were engineers,
Mm-hmm.
and I come from a family of engineers, so it wasn't hard for me to speak engineer essentially. Um, and they asked questions that no other clients ask.
Mm-hmm.
And they wanted to dissect and deconstruct and examine and analyze, and they're looking for, how do I optimize my options so that I get the best possible outcome here?
Okay.
And they go deeper than anyone else does, as you could imagine, as you would expect. So because of the commercial appraisal background, I just happen to have the skill set to be able to create the spreadsheets, to do what I needed to do to answer the questions they had.
Yeah.
And there was no training for that. I mean, nobody else practiced this way.
Yeah.
So one of the things I learned how to do pretty early on is I would build spreadsheets and embed my email address and phone number in the spreadsheet, and then just send it off to the engineer so they could play with it. And they liked it so much they would pass it around. And of course, every time they passed around the spreadsheets, they were passing around my contact information.
That's ingenious too. Good thing you embedded your email or your contact info in there, huh? Yeah.
Right. So what ended up happening is probably 2/3 of my clients are engineers.
Okay. Amazing. Yeah, and that's a difficult niche to serve. But like you said, if you speak engineer and you have the tools and you have the resources, they're probably lining up to work with you. They probably don't want to work with anyone else at a certain point.
They are, but the great thing is they're super qualified. I mean, these are people with 800 FICO scores and good reserves in the bank and great income, especially in this area.
Yeah.
And so it's just easy to work with them because they're reasonable. They want to examine a little bit more deeply than other people do, but they're looking for, how do I optimize my options here? And it's a pretty simple question.
And it's like you're solving the problem with them, right? You're on their side of the table or the desk and helping them figure it out. And excuse my ignorance, but is this like mechanical engineers? Is it computer engineers? Is that what you're talking about? Or?
Well, it's Silicon Valley, so it's mostly electronic engineers and software developers.
Because you said in the 90s, and that was, when it was just getting ramped up. Looking back, those must have been some crazy times, seeing Silicon Valley just explode, huh?
Well, I was born and raised here, so it was exploding with high-tech engineers in the 60s and 70s.
Oh, okay.
It just wasn't that well known.
Yeah. Yeah.
We didn't have Google and Facebook and Yahoo and those kind of things until the 90s.
When we had fun dial-up AOL internet, huh? With the
I remember that.
The most annoying sound ever, huh? Okay.
Horrible.
And I went to your website, which is very impressive. You have some really, really good substance there with like mortgage calculators, different mortgage calculators and financial calculators for consumers. One of them, of course, which you feature, is the refinance benefit analysis calculator. Tell us a little, if you will, about those, and maybe you'll even pull it up and take us for a spin, huh?
Yeah, I would love to. So the big question is should I refinance or not? And most of the people refinancing today, for instance, in this kind of an interest rate environment, are trying to save money, and the way that the refinances are sold is a simple payback analysis. They say, well, this is going to cost you $3,000 and you're going to save $300 a month on your payment. So in 10 months, you've made back your money, and after that, it's all profit. Very common, in fact, almost a universal way of looking at it. The problem is it's bad math. And I was taught how to do it that way. And the first engineer I worked for said, you know, that's really bad math. That doesn't make sense. And I looked at it and went, oh, you're right. And I can show you why, I can explain why, but it's just easier to show you why it's the case. So I developed.
If you don't mind me jumping in, because I have a question about that. That first engineer, he or she said this is bad math. Did they tell you what the correct math was, or did they just point out the problem and you had to figure it out yourself?
What they did is they pointed out the problem, but they didn't know how to figure it out either. So it wasn't that hard for me to figure it out because of my background. But the essence, of course, is that the drop in your mortgage payment is not all savings.
Yeah.
It feels like savings because you have $300 a month less cash going out of your bank account. Feels like you're saving $300 a month, but you're not. You're resetting your mortgage, and when you first start a mortgage, less of your payment goes to principal and more of it goes to interest. So your interest savings is never as much as the entire payment drop.
So all these payment calculators, or most of them that we see online, they sort of look at surface level, like you said, how much monthly payment, how soon do you recoup the cost of refinancing, but they don't really layer over that whole matrix of amortization with the principal and interest distribution, huh?
Correct. And they also don't account for how long you think you're going to be in the property or how long you think you're going to keep the mortgage. And that's important because if you're only going to own it for a couple of years, it's almost certainly never going to make sense to refinance. So that's where you have to really start to dissect the whole thing and answer a lot of assumptions before you can determine whether or not it actually makes any sense.
Yeah, and we know that I think the average, at least in California, is probably every 3 to 5 years a refinance, and 7 to 9 years people move. So they probably are their own worst enemy when it's trying to save money with the mortgage, huh?
Well, actually, in California, we don't move that often.
Oh, okay.
There's a weird thing with property taxes in California where the longer you own your property, the cheaper your property taxes are relative to the people around you.
Okay, because it could only escalate a certain percentage every year. It's capped, right?
It's capped at 2% growth per year. So if the properties are going up 20% a year, it doesn't matter. Your property taxes are only going up 2% a year. It's called Proposition 13. It was passed back in 1978. And so there's a huge disincentive to move in California until it's just something you can't avoid, and then you do it.
Yeah. See, my reference is Sacramento, which is different, right? It's it was sort of didn't start really escalating and appreciating rapidly until the early 2000s, but Sacramento people were refinancing every 6 months until they foreclosed, and then it starts over again. So a little bit different than the Bay Area. You guys are doing something right.
That's true. That's true.
Well, great. Yeah, if you don't mind, we'd love to take a look at the refi benefit analysis calculator.
Yeah, absolutely. Let's take a look here. I'm going to share the screen.
Sure.
And I am going to go to the website. So this is the website. I've owned the URL since about 1997. So I've owned it for a long time. It was idle for a few years, but now for the last 15 years, I've been pretty actively adding articles. So there are literally probably 300 different articles on here. What you'll see is there's a bunch of different calculators here that can be really useful, and a lot of these are built based on what engineers have asked for.
Okay.
But the one specifically that we were talking about is, will refinancing actually save you money? Now, if you are refinancing for the sole purpose of saving money, this is the calculator you want. If you're looking to pull cash out because you want to use that for something, it's different. Or if you just want to lower your payments and you don't care whether you save money or not, then that's different. But if you're looking to save money, this is the calculator that you want.
Okay. I'm excited to see this.
It's actually pretty cool. So I built it as an Excel spreadsheet and used it for years and refined it based on feedback from my clients, who, as I say, have taught me so much. And then last year, I found a programmer, a brilliant woman from Argentina who happens to be living in Texas, who was able to convert it to an online calculator. So
Wow,
I'm really excited about all
that. Must have been quite a process. I bet you guys were crunching numbers till smoke came out of your ears, huh?
Well, she didn't understand the math. So the biggest challenge we had with all of this was getting her to understand how to program, discounted cash flow analysis and that sort of thing. But like I say, she was brilliant. It wasn't her wheelhouse, but the programming was, and she did a terrific job.
Yeah.
All right. I am afraid I'm going to have to turn my overhead light on again if I'm going to read this to see, because I've prepared a couple of scenarios. So excuse me 1 second.
Yeah, go for it. No problem. I could play the hold music.
I actually have I've recorded that specifically for it's specifically for Zoom meetings.
Oh yeah,
because I found it so necessary. So I'll start playing it when it kind of bugs people.
Yeah.
Let's see, original loan term would be, we'll call it a 30-year fix. The current balance. Now I'm using numbers that you wouldn't see in Silicon Valley.
No.
Like
maybe for the garden shed out back, huh?
Right, exactly. But it's useful. Like in the book, I use samples that could be true anywhere.
And what year did you write the book, The Loan Guide?
Oh, I wrote it over a 5-year period, and I published it in 2014.
Oh, okay, great.
And I'm actually in the process of splitting it up into smaller books, and I'll be republishing it.
Smart, yeah.
So if we assume that somebody has a $300,000 balance at 4.25%, and their payments are $1,777 a month, then they have about 21 and a half years to go.
Okay.
All right. Now, I chose this example because it will really underscore how important it is in terms of resetting your loan amount.
Okay.
Or resetting your payoff period.
Yep.
And I hear all sorts of things like, well, if you can drop your interest rate by a quarter, you should always do it.
Mm-hmm.
Or if you can save $200 a month, you should always do it. And it's just nonsense.
Yeah.
I mean, there's no reason that you have to do those kind of rules of thumb when you can just actually just do the math. So we're going to finance the costs here into the loan amount, and we'll assume $4,500, which is high side typical for California.
Yeah, that seems pretty typical, yeah.
We're going to do 0-point loan, so there's going to be no fees, and the interest rate is going to be 3.5%. So we're dropping the interest rate by 3/4 of a percent. It's major, right? That's a big drop.
Significant, definitely.
30-year loan. There's no MI required. Now your payment is going to be $1,367.
So the consumer at first glance goes, "Oh my God, I'm saving, $400 and change, huh?"
Correct.
Yeah.
So now you get $400 and change, or $400 of savings. So this is the payback analysis, and it shows that you're getting $400. So you're going to recoup your $4,500 in cost in 11 months in this example. Okay, this is what everybody will show you. And who wouldn't say yes if you can get your money back in 11 months?
It looks like a slam dunk. Yeah.
It's a slam dunk. It's a
Yeah.
slam dunk.
Or
But
in the Bay Area, I should say, it looks like a 3-pointer. You guys like those better, huh?
ever since Stephen Curry got here, yes. So you can also take a look over. Now, I've assumed, if we go back up here, I've assumed a 7-year holding period. And that's, we'll throw in a safe rate too.
Now explain, if you don't mind, meaning they're only going to hold the property and or the loan for 84 months before, we're just looking at 84 months before they sell or refinance.
Correct.
Okay.
Now, and that's sort of my starting point with most folks. But then I'll start talking to people, and they go, well, we're thinking about having a kid in 2 years. Well, is that going to create a motivation to move?
Yeah.
Because if it is, then maybe we should be looking at a shorter time period.
Is that 2-bedroom, 1-bath ranch that you're in gonna, are you gonna outgrow that very quickly? Yeah.
Correct. So now going back down here, if we look over the next 7 years, your current loan is going to cost you $80,000, and the proposed loan will cost you about $70,000, right? So you're going to save $10,000, and that's $70,000 is the interest plus the $4,500 in costs.
Okay.
So it still looks okay. Over the next 7 years, you could save about $10,000 in interest cost. But here's where recycling the loan term comes into play. If you just keep your current loan, in 7 years, you're going to owe $230,000.
Okay.
If you refinance, you're going to owe $258,900. So you've saved $10,000 over 7 years, but you owe $28,000 more.
At the 7-year point because of the amortization schedule. Yeah.
Correct. So this is where you have to really start thinking about it. Now you go, well, okay, now is it a no-brainer? It's no longer a no-brainer. I think we can agree on that. But then the question becomes, well, what is it a good idea anyway? What if I take that $410 every month and invest it at 2.25%, which is our safe rate, meaning that we think we can invest it at 2.25% and earn that money pretty safely.
Yep.
Then if we did that over 7 years, then we'd have $37,000 in the bank. So even though we owe $28,000 or almost $29,000 more, we're still $8,500 ahead. This is after 7 years. So think about this now. To do this refinance, you're going to pay $4,500, even if you finance it. It's still money that you pay, right?
Yeah.
And then it's going to turn into about $1,000 a year savings, because in 7 years you'll have saved $8,500.
$8,500. Yep.
So,
now that's of course assuming that which this is where the human element gets involved. Assuming that $409 or whatever monthly, they do the right thing and they invest it, which we know maybe with engineers, but with the rest of us impulsive folks, that rarely happens as planned, huh?
well, that's exactly right. And so that's what we do is I'll sit there and say, how likely is it you're going to save it? How likely is it you're going to spend it? Do you like steak dinners, and do you have like a really expensive steakhouse in town? So it becomes, this calculator is not meant to say to you, you should refinance or you should not refinance. The purpose of the calculator is to give you data so that you can then make an informed decision. That's it. Now,
it's fascinating, yeah, and I think instantly too, maybe not for engineers, like you said, they're very financially conservative and stable, maybe even not for a lot of people in the Bay Area that are of means, but with that savings, you assume that you're investing it at the safe rate. The other use for that money, which may layer on top of this calculator, is to pay off quote unquote bad debt. So maybe they have
Yes.
a car balance they're getting beat up on, or they're, maybe they have a $10,000 worth of credit card debt and they haven't paid attention and it's at 12% or something, whatever the case may be. That's where you probably really see the value of this snowball, huh?
That is an excellent point. And one of the things that I don't have very many people that come to me with a lot of credit card debt.
Yeah,
It's just
yeah,
not that common here. But I do have some, and I will tell them that if you take that $400 a month and apply it towards your credit card debt, you're not investing it at 2.25%. You're investing it at 12% or 15%.
yeah.
If you're knocking out credit card debt, your return on investment is literally whatever interest you're saving. So you just made an excellent point. If that's the situation, then sure, I would say you should go for this and then get rid of that debt, especially if you're that tight every month.
Yeah. And that could basically work with any, revolving debt, of course. And maybe, like we said, not the average engineer in Silicon Valley, but, there's a lot of homeowners maybe got in the house with a FHA loan, or they just barely became first-time buyers and qualified, and maybe 2, 3, 4, 5 years down the road, their house appreciated. Maybe if it was a FHA loan, their PMI fell off. Is it MI or PMI with FHA loans?
It's commonly called PMI, but it's
Yeah.
sort of incorrect, but that's okay.
Yeah, but you know what I mean? They're at that point where, but maybe
Right.
they do have a car payment and they have 10, 15, 20 grand in credit card debt, and maybe an installment loan or a student loan still. So that's where this, the value of, just like you said, educating yourself and knowing the true cost and the numbers, the value of this is exponential to them. Yeah.
Exactly. It's really important to be able to take a look at this and find, and this is what I was talking about with engineers always wanting to optimize their options. What you want to do is find the path that keeps as much money as possible in your pocket over whatever period of time you think is relevant. That's it. That's the game.
Yep.
Right? It's like there's going to be two piles of cash at the end of, let's say, 7 years. One is your pile and one is the bank's pile. How do you make your pile as big as possible? That's it. That's all this data tells you.
Basically, it's like a game, but people are playing with only half the rule book. And all of a sudden you hand them the full rule book, and now they can play to win if they choose,
Correct. It's a little bit like if somebody was teaching you how to play chess and said, well, you should always just attack no matter what.
Yeah.
Well, you'd play an aggressive game, but you'd lose most of the time.
So when you first show this to people and sit down with them, I'm sure the light bulb goes off, and not a selfie ring light, but the actual light bulb over their head, the epiphany, especially with engineers. But do they instantly start having fun with it and say, ooh, let's fiddle with the numbers? What if we stayed in the house 10 years? What if I could get 4% as a not so safe rate,
Instantly. Yes. They will start playing with the numbers.
Yeah.
And that's why I developed the spreadsheet and sent it to them, because that way they can play all they want, and they'll play for hours on it.
Yeah.
And they'll find, oftentimes they're going to find solutions that I didn't see by playing with those numbers. And they'll call me up and they'll be real excited, and they go, oh, well, here's all we have to do. And anyway, it's pretty interesting. It's really interesting working with really smart people.
Yeah.
I really enjoy. The last piece of the analysis is taking a look. So your current loan is going to be paid off in 21 and a half years. So let's say that you wanted to say, okay, now we know that stretching it out over 30 years is actually going to cost us some money now over 7 years. What if we made a payment to pay it off in, say, 21 and a half years? What would we have to do? Well, if you remember, way back up here, I'm going to move slowly because we're on video. So our new payment is $1,367, but it turns out that if we paid $1,682, we'd be paying the new loan off in 21 and a half years.
Oh, so you could calculate for an additional principal payment.
You calculate for an additional principal payment. So let's do that now. Take you back up to the top, and it changes the term of the new loan from 30 to 21.48. And here's the new payment.
Yeah.
Now, what does that do for us? First of all, instead of $400 a month in savings, you're only saving, quote unquote, $95. Your payment only goes down that far. So now, if you do that, it's going to take you 47 months instead of, as you may recall, 11 months before to pay back that $4,500 in initial costs.
But when we go to the total cost of the loan, right?
Then we go to the total cost of the loan. Now, the savings is even greater. It was 10,000, but because now you're paying the principal down faster on the new loan, your savings is now $13,000. And more importantly, instead of owing almost $30,000 more on the loan after 7 years, you owe $1,200 less on the new loan than you would, and you're still paying it off on the 21.5-year schedule.
So, I mean, that's the true sweet spot where, hey, look, yeah, you know, you want to refinance. Of course, you want to save a bunch of money. This saves you a little bit, but you finally hit that threshold where your true cost of the loan has actually lowered as well. So that's the win-win. Yeah.
Exactly. So you can see that this all came about as a result of engineers playing with the numbers, right?
Yeah.
So when you run through it the first time, you go, should I refinance or should I not? Well, it looks like maybe I should, maybe I shouldn't. It's not a no-brainer. But now, if you think that making the higher payment is reasonable, $1,682 instead of 13 and change, then now there's no question if you're going to have this 7 years, it's totally reasonable.
Yeah. Yeah.
That it makes sense. So it's all about, it's not just about should you do this or should you not do this. It's about creating a plan that puts you in the best possible situation. So like you were talking about, if you happen to have credit card debt, sure, do a rate term refinance and then use the monthly savings to knock out the credit card debt. That's the plan. So the plan it depends on your circumstances and your concerns and your goals.
Yeah, and so your calculator allows them to put way more variables into the equation with accuracy. How long are they going to stay in the house, or how long do they think until they refinance? Are they going to put extra money towards principal? Are they going to, invest the savings, and at what rate of return, or pay debt? So that's fantastic. I'm damn impressed how comprehensive it is.
And it's once using the calculator is actually quite easy.
Yeah.
And it's not hard to understand either.
Oh, believe me, if I could understand it, then anyone could understand it.
What I did prepare is an example with a lot more time remaining.
Okay.
And let's go through that one. 1565. Okay. So this one is 1565 means he's got almost 27 years left to go.
Okay.
And the reason this is important is because now with more time left to go, what you're going to see is that you don't have to drop the interest rate very far for it to make sense.
Okay.
So if somebody comes to me and they've only got 2 years gone on their existing mortgage, we don't have to drop that interest rate very far.
Yeah.
So in this particular case, what we're going to do is we'll use all the same numbers here. We'll go to 3.75. Now remember, 3.5 was dicey last time. So we'll go to 3.75, and the mortgage payment is $1,410. So now we're talking about only $150 a month in savings, roughly. A 29-month payback because the discount or the drop in the monthly payment is less. And even though you're paying $4,500 a month or $4,500 in initial costs, and your payment only goes down by $150, you are at $8,000 in savings over your holding period.
Yeah.
Now you do owe almost $10,000 more.
Mm-hmm.
So you remember that, but you're now really close, you can see, even though you didn't drop it all that far. And then if you if you increase your payment to 1503, all right, then now, so we have the 26.78 term, the 1503 payment. So now you're only saving $62 a month.
Yep.
It will take 73 months to get paid back, but over 7 years, you'll save $9,000 in interest. That's the cost.
Oh, that's a monumental change just with that additional principal, huh?
It's a monumental change, and it's not a lot more. What you can see here is you're almost even after 7 years.
I bet when people
But
see
you've saved $9,000.
yeah, I bet like we talked about, when people see this and they maybe come to you, okay, I want to save monthly. They maybe get excited by this and say, well, what if I kept about the same payment I have now, even though I refinanced? And then it really adds up the savings over long haul.
Yes,
Fantastic.
and that's where we'll do this. That's where this calculator comes in. Well, that's embarrassing. So there's a calculator that will be here the next time someone clicks on it. It's an Excel calculator. It's not online.
Yeah.
And it's what it does is you put in your current loan data, and then you can either examine the biweekly payments or making a little extra payment every single month to see how it's going to impact your payoff period and your lifetime costs. And that,
oh, go ahead.
I was just going to say, that's a calculator that was developed specifically at the request of engineers.
Wow. How about the home improvement calculator that I saw on that front page? What does that one look like? I'm just curious.
Well, that one, I wouldn't be surprised if that was a 404. Yeah. So that one is a calculator. It's kind of interesting. So before the financial crisis, a lot of people were coming to me and asking for consolidation loans.
Okay.
Specific. They were pulling cash out. There was a ton of equity in properties. Interest rates were low, well, relatively low, not compared to today, but they were pretty low. And so people were yanking a lot of cash out of it. They were using their cash like in an ATM. And here's the problem, and I write about this in my book. If you pull cash out to put in a brand new kitchen, which usually has a pretty good payback in this, then you're improving your home and you're paying that off over a 30-year period. And that's probably appropriate because you've improved your home with an improvement that's going to last 30 years. Well, what if you're putting in instead a water heater or a furnace? Let's say a furnace, because that's pretty common here. Furnaces can be pretty expensive. And so you might pull $20,000 or $25,000 out to put in a furnace, but the furnace may only last 15 years. But you've financed it over 30 years by using a new 30-year mortgage. So what's happening is you're paying for that furnace for 15 years after you've had to replace it again. So I think that's a bad idea. And then I go to the example of your credit card debt or a car. A lot of people will pull money out and go buy a car with it, but now you're paying your car off over 30 years. How long are you going to own and drive that car?
Yeah.
Probably not 30 years.
Yeah.
In my family, we do.
Well, it
until
depends if you buy the right car, right?
Until they're classics. But most people don't. So it's not a good idea. But then when you pay off credit card debt, now you're financing your shoes over 30 years.
Yeah.
So it's a terrible idea.
Your Starbucks coffee for $3.50. What does that run you when you finance it over 30 years? If you pay off that credit card and
Yeah, that coffee just cost you $12.
Yeah.
So what I did is I built an Excel spreadsheet where I said, what payment do you need to make in order to pay off the each component within its lifespan?
Oh, okay.
And so you took the new 30-year mortgage, and then you said, well, to repay, like so the mortgage has the mortgage you're paying off has 25 years left to run. We're going to give that portion of the of your new mortgage a 25-year payment, and then you're putting in a roof, which is a 20 years. We'll pay that portion off in 20 years. You're going to buy a car, which will last maybe 10 years. We'll pay that portion off in 10 years. Your credit cards, you would pay if you just stopped spending, you'd have them paid off in 5 years. We'll pay that portion off in 5 years. So I broke it out.
Wow.
So I could calculate a new payment on the new mortgage for the client so that they would be able to pay off everything over whatever period of time they would have paid it off or should have paid it off, because its lifespan wasn't any longer.
And they could add that calculator, they could add line by line, like you said, they could say furnace, 15 years, car, 10 years, And
yes.
Oh, wow, that's amazing. Yeah.
And well, it was amazing. And I've had exactly 3 people use it.
Yeah. Yeah.
So that's why I said I don't think it's even on there anymore, and we need to probably change that, because it turns out that as interesting as it was, you have to that whole concept has to be important to you, and it wasn't important to everybody.
So the person who's treating their house like an ATM machine maybe isn't interested in the statistical, truth of how to pay it off correctly. And I see, and I don't mean to demean anyone, but we're all guilty of it. I definitely have done, a lot of foolish things with mortgages and homes. And so it's all about education, right? Which is essentially what you're doing. And you're giving people tools that they didn't have before.
Exactly.
With what you're doing now, especially with the refinance calculator, do you get pushback? Like, has this gotten out in the mortgage community where you have people saying, oh, that's not legit, or, any sort of pushback from loan officers because it makes them think harder and sort of pokes holes in what they're doing?
Not really, because I don't publicize it to loan officers, so I don't get much pushback there. And also because of my because I've been involved in the industry so long, and I've taught classes and I've coached loan officers and mentored them and everything else. The loan officers, I have showed this to some loan officers, and their reaction is usually, well, that's really not helpful in terms of selling the loan.
Yeah, well.
And I tell them, I say, no, actually, it's very helpful, because it helps you show them how to plan and optimize.
Yeah, it's
and
helping
yes,
the consumer. Yeah.
There'll be a couple that you say, no, well, looks, it just simply makes no sense for you to do this.
Yeah.
But in the long run, that's a good way to build business. In the short run, you might lose a loan, but in the long run, you'll get a lot more.
Well, like you said, your results, your value were your advertising, because just as it started putting out that spreadsheet with your email on it, and it got passed around without, you doing anything, because it was so valuable and had such good information. So no, that's definitely, I know, but well, Casey, thanks again. I really appreciate it. That was fun.
Yeah, very nice to meet you, Norm. And